Hey, welcome to a very special episode of the podcast. Today, we're going to be talking about not just the coronavirus, but all of the actual impacts of the virus on the stock market, the real estate market, the lending space, what you should do, what you should not do, who should take advantage. That's a mouthful. We got a lot going on. Today, I have Derek Williamson, Dean Lawton. I'm Alex McFadden. Listen to the podcast. Let us know what you think. Subscribe, give us a review, and we will talk to you guys soon. What's up, guys? You are listening to the YVR REMO show, where we talk all things Vancouver real estate and mortgages, take boring topics and make them interesting. Make sure to stay tuned to listen to everything you need to know how to put cash back in your pocket, create wealth in real estate, and simplify the complicated. Welcome to this week's episode of the podcast. We are going to get right into it. Lots has happened over the last few weeks in real estate. We're going to talk about an ongoing topic, something that we've talked about. Wow, we predicted it. Well, I would say we predicted it, but we had the conversation about 3, 4, 5 weeks ago about the impact of the coronavirus on interest rates at the time. And it was before it happened. Then we saw fixed rates go down, and then we saw variable rates go down, and then we saw a whole bunch of other stuff happen. So the purpose today is to really round up everything that we know about, not the virus per se, but the impact on the financial markets, in particular, lending, real estate, and try and bring some sense of calmness or understanding to a crazy time. It's actually insane to look out there and see NBA seasons canceled, and NHL and concerts and all these little things. And, well, guys, how do you feel?
Shit's getting real. It's starting to seem real for sure when you see big things like that happening, right? Like Trump, I believe, put a short-term ban on travel from the U.S. to Europe for 30 days as of yesterday. So it's interesting for sure.
Yeah, I mean, just in regular day-to-day stuff, obviously, if you're a hockey fan or a basketball fan, those types of things are going to impact you immediately. But even just what we're seeing with regular professionals in other industries, staffers starting to stay home, things are just slowing down a little bit. I went to get my car serviced today, and they were missing half of their staff. So just little things like that are... we're starting to see the impact in just regular everyday life events, right?
Absolutely.
Regular tasks.
Yeah, it's been crazy, and you can see our energy levels are a little bit lower today. I'll try very hard to bring it back up. We haven't had our caffeine here. So the purpose today really for us is to go over some of the things that have happened, what we've seen when it comes to interest rates, where there's opportunities for people right now. I mean, hey, it's a terrible time for the world, but it's a good time when it comes to real estate financing. And so we'll talk about what that means and where the opportunity is for you. Should you invest? Should you not invest? Should you buy or not buy? What does that look like? Obviously, we've seen the impact of the stock markets hitting record lows in record times. That, as we are aware, but a lot of people are not aware of, has impacted the interest rates. So why don't we get Derek right into what we've seen when it comes to, first and foremost, fixed interest rates, because that's a question I've been getting right now. Like, what have you seen happen in the last couple weeks here?
Probably in the last 3 to 6 weeks, there's been a drop in the range of 0.6%, I'd say, off fixed interest rates. About a month ago, we were sitting just above 3%, 3.09, 3.19, and they're down as low today at about 2.59%, which is, it may not seem massive. It's about 0.5%. But when it comes to mortgage financing, because you're borrowing such a large amount of money, it's drastic, the savings that you can accumulate over 5 years, 10 years, 30 years. It starts to add up. Fixed rates have dropped. Obviously, the main reason, just to make it very boring and short, is so people have pulled money out of public markets and they buy bonds. Now, our fixed rates in Canada are tied directly to the bond price. So when the bond market gets flooded, the price comes down and our fixed interest rates drop along with that. So that's pretty well the main reason that fixed rates have come down, and people are pulling money out of public markets, obviously because of what's happening with the global economy, if you want to say that.
Yeah, and flooding the market. And so those rates that you mentioned, the 319 to 259, these are what we call conventional mortgage rates. So this could be for someone who is maybe refinancing or putting down more than 20% or something of that nature. We've seen interest rates come even lower, substantially lower than that. over 0.5%, or not 0.5%, sorry, over 0.25% for someone who's paying for mortgage insurance. So that's interesting. We should make a point on that.
For sure.
And this comes a week after we saw variable interest rates hit the news. Like literally a week before this, we were talking about Bank of Canada, Prime, and what does that all mean? And I get questions about this every day right now, just because we don't normally see both the bond market come down and the key lending rate come down so dramatically at the same time. Dean, what did you see last week, and what are your thoughts on that?
Yeah, I mean, it's been significant. I think where I've noticed a lot of, I guess, panic or concern is people that are already purchased a home and waiting for it to close and wondering if their rate that they took 2 weeks ago is going to be impacted and go down. And so, maybe you and Derek can just touch on that, the type of advice that you're giving to our clients that are in that position, essentially waiting for their new property to close.
Well, I think there's a couple key points here. We'll talk a little bit about what we do and then what we're seeing right now. So I get a lot of people asking right now, is the right time to take a fixed rate because the rates are low, or is the right time to take a variable rate? I'm going to say first and foremost, I'm going to plead the fifth here, and I'm going to take, it depends on your financial situation and what you're willing to do. There's no one thing that's the right way. I hear a lot of people say it's always this way or always that way in the marketplace. And it's not that there's one right way. We tend to lean variable a lot in a lot of times in situations, and now could be a great time to go variable. But with someone's personal circumstance, that may lead us to look into the fixed rate as a solution. Would you agree with that? Or
For sure. And I think it comes down to, I mean, you said personal preference, which it is. If you want your mortgage to be completely hands off and you don't want to have to think about it, if it's a comfort thing, there's absolutely nothing wrong with going fixed, because fixed rates are at probably a 2.5-year low. Obviously, there's a lot of benefit of taking the variable. And what could that be? If you take a variable right now, maybe fixed rates continue to fall even further, right? And if you're interested in watching that, and actually it's almost looking at it like the stock market, if it goes low enough, you can actually flip your variable into a fixed at the perfect time, right?
Yeah.
But again, some people don't want to have to think about that after they've just bought their first house and they're moving in and they have all these new, aspects in their life.
So so we're going to pump our own tires here for a second, because this is something that we do. So what if you locked into a fixed rate mortgage 2 months ago with another institution? You haven't closed, you're closing for another 30 days. This is where our team really shows up, because what have we been doing all week long? All week long, we've been calling every lender and every bank that our clients have a mortgage with to check in where the rates are for that client and get them dropped. Even if it's like a day before closing. I think you did that the other day, where it was a client literally closing the next day, and you called and got them dropped by almost 0.5%, which was pretty awesome. So that's something that we do, but your bank will never do that. They will not proactively call you and let you know that. So very key point. So first and foremost, if you have not closed on your purchase, you should probably give us a call for a second opinion, and we can help you get that down. And it's important that we say that, because there's a lot of people. I was talking to actually somebody yesterday who did not choose to go with us for a variety of reasons, and you know what, their interest rate ended up being 0.5% above today's rate, which we could help them out with. But let's not talk too much about that piece. Let's actually break it down into numbers. Like, what does that mean in difference in interest from then to now?
Yeah, so if you take a $500,000 mortgage, just for easy numbers' sake, about a month ago, 3.19% 5-year fix, your monthly payment's about $2,159, $2,160 if you want to round it up. So if you were to break that down and drop the rate to 2.59 based on today's best rates, payment drops to about $1,995, right? So the difference is about $165 every single month, and that's just payment, right? That doesn't factor in interest savings and principal pay down. So those differences,
I mean, that's significant. That's out of pocket. So you're saving $164 a month out of pocket, right? That's a big number for a lot of people.
A couple nice meals.
Yeah, absolutely.
A good sized grocery shop.
Yeah.
Ooh, all right, some diapers. You need some of those real soon, bud.
Oh yeah.
So the monthly payment thing is obviously huge. It's immediate cash flow. It helps with cost of living and style of living, if you will. So principal pay down is another big difference. Because the interest rate's gone down, that means you're paying less interest and more principal within your payment. So because of that, you're going to pay down about $5,000 more principal over your 5-year term, right? So that's an extra $5,000 that you have available in equity after 5 years.
Huge.
In addition to the monthly savings of the out of pocket.
Yeah. And then there's one more.
Oh, tell me more.
So That is the total cost, right?
Let's work out our numbers here. So the 165 monthly savings, the $5,000 off of the principal that you're paying down on the loan, which is basically paying down the loan faster, and then the $15,000 savings in total interest over the term is how much you're saving. So that equals about a $20,000 difference from a month before, like a month ago.
Yeah,
0.6% different. Unreal. But that doesn't even factor in, like we talked about, you're saving money. But we can make this even better. It's like ShamWow here. One more thing. So here's an interesting strategy that we recommend to our clients often that you would never hear from anywhere else is take that difference in savings, right, that 165, increase your payment by that 165, and then you're going to automatically triple up on the amount of principal you're paying down. So you're not going to pay down $5,000. You're going to pay down $15,000 of total additional principal. Your interest would also drop in terms of total interest paid dramatically, which is huge. I mean, I'd have to work out the numbers specifically, but that's a massive difference between the two. And you don't have to go the full 165, but you could cut.
Yeah. So I mean, just in simple terms, by taking that $165 additional money that you would be saving out of pocket, and you're just applying it right to principal. So it's going directly to a principal, which it's huge. And I mean, again, that you're going to want the proper mortgage product that allows you to do that.
Yeah.
But they're available.
Yeah. So it's really quickly, last thing I want to touch on the rate side of things is I've had a lot of phone calls, emails, text messages, Instagram messages, everything in the last few days with people who have variable rates. And they're asking me right now, like, should I be locking in now? What's going on? Did my rate get impacted? Did I not? I think a few key points on that. First of all, it depends on the type of product you have, whether or not your payment goes up or down. Some clients have what's called a frozen variable rate. The good thing about that is if you're comfortable with your payment already, you're actually going to end up paying substantially more to the principal and less on interest, which means you pay it off faster. That's kind of nice. If you have a floating payment, that means your payment will actually go down by that 0.5%. So you're going to realize those savings. If I were you on the variable rate side and you've been comfortable with that higher payment the entire time, personally, again, a scenario dependent, I'd say ride it out because we might see a couple more decreases. Any thoughts on that? Or
yeah, 100% agree. I mean, picking a variable is, again, it's significant that you have to look at your personal finances, and if you can get a frozen variable payment, then great. You're not, your payment's going to stay the same all the time. But if you're looking at a product that is going to go up and down based on rate changes, you obviously want to be able to weather it up or down. But the thing with a variable, the one thing I always say to clients is it's a long game. If you're going to take a variable, it's something you should be willing to stick with for the entire time. Because stats show since 1982, the variable clients have been further ahead. So if you're going back and forth and trying to ride it out, well, the last 5 years, those variable clients have paid more.
Yep.
But if they continue to keep it for the next 5 to 10 years, they will do well.
Cool. So why don't we chat on, like, a lot of these people want to know, like, where is the opportunity going to be in the next? So obviously the opportunity is going to eventually come in, potentially for some people if you haven't lost money in the stock market. But for now in the real estate market, let's talk about where is the opportunity right off the bat. And I think right away when we look at the lower cost of borrowing, not just living, lower cost of borrowing, we kind of jump into accessing the equity in your home, right?
For sure. Yeah, we help a lot of our clients that maybe they don't realize or they've never thought about, what equity looks like and where you can make use of it. A lot of our clients are accessing equity in the form of a line of credit or a refinance to invest further into real estate, right? Not always, but a lot of the times that's what we're helping our clients do to create long-term wealth. With that said, the line of credit rate has dropped 0.5%, which is massive. Just on the rental property piece, where we live, values are very high, obviously, right? Especially from Vancouver to Chilliwack. It's pretty tough unless you're going to put, a 35% down payment to find a property that's going to cash flow just because of the values that we have here. So this drop in interest rates and variable and line of credit can quite literally make that difference, right? Like we just talked about $165 a month on a $500,000 mortgage. That could make or break your rental property to create cash flow, right? So that's huge. Accessing equity, the money's cheap. It's a great time to get in there and actually utilize it, right?
Yeah, and because of the rate is significantly lower, you can borrow more money. You can
No
qualify
question.
to borrow
No
more,
question.
right?
So you borrow more money, lower cost of living. You can cash flow. You could purchase potentially maybe even a second property if that was the case. We've been running some scenarios here behind the scenes and just looking at it. And obviously we just kind of broke out the $170 difference on $500,000, and that still holds true. But there were a bunch of scenarios that we had put together in the last 2 weeks where they were actually cash negative when we factored in potential vacancy and insurance and all these types of things. And now the next week they're sitting cash positive. So really cool. And these are all 20% down properties that we're looking at right here. Really cool from an investment standpoint. My suggestion from an investor is right now, again, if the cost of borrowing is this low and you have access to equity, is do it now while you can, while you know what the interest cost associated with that is. And our property values have also brought back up. We don't know what the next 3, 6, 9, 12 months look like. And if we see a lot of other people offloading their properties and letting them go out of fear, because we could see that happening with the stock market. They're trying to reinvest. I was chatting with someone today, and their prediction is we will see more property on the market. Then you could be primed and ready to go forward. The key is right now is have the money available. So contact us so we can run that equity analysis and put that together for you, right?
Yeah, and that's an opportunity that you could look at with accessing equity is investing in the stock market. I mean, not that we're going to touch on the stock market or what's good or what's bad there, but I did have a client reach out saying they wanted to sell their house to invest in a certain stock. Well, you can still do that, and you can still access equity without having to sell your home. So
sure, yeah, absolutely. That person I was mentioning earlier just got a $100,000 line of credit to do that.
Wow. So I mean, there you go.
There's people going out now that we don't recommend leveraging your entire property on the stock market right now, but
it is a common strategy that a lot of savvy investors do. So.
Yeah. Make sure you're talking to the right people. So let us know. We'll connect you up. So let's keep going on the list. So we did touch quite a bit on the cost of living. So just standard cost of living has gone down, but consolidating debts is an interesting one right now. We don't take that lightly. Just, hey, let's refinance your scenario and pay out your bad debts or your car loans or your credit cards. But life happens. I was just talking to a client the other day, and they had a family situation come up, and someone was sick, and they had to basically take on $75,000 in debt in the last 2 years. And it just turns out that right now, with fortunately the property values coming back up and the cost of borrowing down right now, this is going to save them really their home.
For sure. I think consumer debt is definitely not uncommon.
Yeah.
I'd say maybe 1 of every 10 borrowers that we deal with might have zero debt. It's actually very, very uncommon. People typically do have vehicle loans or credit card debt or what have you. And like you mentioned, it could just simply be, a life event that's come up, and that $7,500 or $15,000 or whatever the number is. If your income doesn't support being able to pay that off month over month, you're just stuck with that debt, right?
Yeah.
You're making your minimum payment. You can't seem to get ahead. You're not being able to save because of that. So, I mean, yes, there's sometimes always going to be cost involved with doing a refinance to consolidate debts, but you got to think big picture, right? What is it doing for you personally, for your lifestyle, all the different pieces. But at the same time, we're going to look at those debts and see if it makes sense from a cash flow perspective, as well as, a credit card, you can sometimes be paying 19%.
Totally.
Well,
Right.
Yeah, exactly. And it's important to note that there is no variable rate in a credit card or a car loan for that matter. So whatever your rate is,
You're just paying
you
a
got
high
2 years
rate.
ago, it's still there.
Yeah.
It hasn't changed even with the market and all these things that are happening. So you could easily roll that into your mortgage and have a really good mortgage rate on those products, right? So it's something to think about. It's just structuring debt in a really smart way.
So another example is I had a client that owns a property. He wanted to buy another property. He had his down payment. He didn't want to touch his existing, but he didn't qualify because he had a big truck payment, $750 a month, right? And as much as he didn't want to roll that truck payment in and prolong the payments, he allowed him to qualify for the purchase, right? So we refinanced the existing property, consolidated the truck loan because there was enough equity, and it allowed him to buy what he wanted to buy, because prior to that, he just simply couldn't, or he had to sell the truck.
Right. And so he could also choose, depending on the product that he had, maybe you recommended this, to actually increase his payment by that allowable amount too, after closing.
Yeah,
which
absolutely.
could keep it so that he actually pays off that loan in the same amount of time, right?
Yeah, not to get too technical, but the way that those interest rates compound on a car loan compared to a mortgage, it's significantly higher, and that's probably another discussion. But overall, that client is far better doing what he just did.
Totally. So let's keep things interesting here. Let's talk about predictions. This is what we're paid. No, it's not. But we like to think we were paid for predictions. We are not. So let's break down. We talked about this a little bit beforehand. So we're just kind of spitball on what we're seeing in the market right now, what we're hearing based on talking to some educated professionals, reading quite a few economist blogs, and what we're seeing in the news. Since this is also fresh and so new, it's really uncharted territory for everybody I know. But I'll jump in right away and just kind of talk a little bit about the Bank of Canada and the variable interest rate and what we might see on that side of things. Again, based on what we are seeing and the overall economy and the impact of this virus, we're going to see potentially job loss. We are going to see a reduced trade demand. We're going to see people spending less money. It's going to hurt the economy, and the government is likely going to have to stimulate it at some point. If this takes 1 month, maybe less so than if it takes like 3 to 6 months. We are likely or highly likely to see another 1, maybe 2 rate drops happen this year. Who knows for how long? Again, it depends on how long this pandemic lands out. But that's a win on the side of the variable rate client. So there's a key consideration right there. What do you guys think about that? Do you agree? Or?
Absolutely.
Yeah, I would definitely agree. Just on the variable piece, so that's Bank of Canada changing rates, right? That would essentially drop all existing variable and line of credit products. Something that we've talked about internally here is so there's a discount on variable rates, right? They take your prime minus, call it 1%, right? So right now we're seeing variables in the range of prime minus 1, so it's around 2.5% roughly. What we think will probably happen over the next 2, 3, 6 months is those discounts will probably start to shrink because prime rate's becoming so low. Right, so that could happen as well. Instead of it being prime minus 1, it could come down to prime minus 0.7, 0.8, 0.6.
I hate to update you. We got an email about an hour ago, seeing a lender already send up updates that they're as of tomorrow, like just came out. So we'll look at that.
And that's super common. That's what we saw last time that the Bank of Canada got the rate way down before it started going up. The average discount was prime minus 0.40. So we could easily see it get back there. And so even more reason to secure a really good variable discount now, because that's the part that doesn't change. If you sign a term, a 5-year term for a prime minus 1, it doesn't change.
Yeah.
So
yeah, absolutely. So number 2, we were talking about the fixed rates and what's happening right now. Again, the bond market's in the tank, and we haven't seen the rates continue to go down. But if it continues like this, they have to come
for
down,
sure,
right?
For sure. It seems like every day they're coming down almost. It's something that we're obviously going to continue to watch. But yeah, we are predicting that they will.
Things are still coming down.
To fall.
It doesn't necessarily mean that you should wait, because the interesting thing about this is this happened so fast. We could see things flip right upside down if we see positive signs next week.
Yeah. That's what I wanted to kind of finish on, is the positivity. If you look at China, who got the biggest impact to this whole coronavirus first, they are totally turning the corner, and things have come right back. They shut down their Chinese basketball league. It's back on. Like the number of viruses, presumptive cases, and people that are actually getting diagnosed with it, that's dying down significantly. So things are turning the corner. Their markets are coming back. Everything's coming back in China. So if our country is doing the right thing to, protect us from this virus, we are going to see things turn around. It will happen. There will be correction here. So yeah.
No question. In the meantime, I think it's important for anybody who's out there shopping for a home, getting a refinance, working with us. Some really, really key tips. I don't know if we got onto this already, is people are working from home. A lot of people aren't at the offices. Lenders have been emailing us in the last day or two, advising us that they're going to have reduced staff. So if you are making an offer on a property out there searching, just keep in mind that your timelines will be reduced. Now, we're still working here full time. We can talk. We're still working here full time. Neat thing about our process is that we built it so we could be anywhere. So that's kind of cool, but we can't control the lenders and their timelines. So have a little extra patience on the side of lending institutions, the appraisers, especially because they're physically in contact with people. And in particular, your real estate agent, right? So there's some cool ways that you can get around this. You can still access it, and it might benefit you, which is obviously virtual virtual. So we do everything online if you need to, video. And then when it comes to real estate, I mean, the videos are pretty awesome these days, virtual tours, all that kind of stuff. So you can still search safely. You can still refinance without even, leaving your house and get all the information that you need. But be aware that this type of a situation is pretty unique and it does impact timelines.
Yeah, and as fast as it came and hit us, it can basically turn around and go the other direction that quickly.
Gone overnight. What are you guys' thoughts on? Do you guys want to jump in predictions on the thoughts of the real estate market in terms of price points? Any feelings there, or just we don't know what's going to happen here?
Well, yeah, as of right now, it's crazy, right? There's multiple offers and things are moving. Values are in a really good position. So where it's going to go, I would assume it will taper out a little bit at the very least, but.
Man, this is the biggest unknown I've ever dealt with in the real estate career. Yeah. What about you, Derek? Any thoughts on that?
Yeah, I don't know. I'd probably match what Dean said. Like right now it is crazy, and obviously driving interest rates low is speeding things up, and that's the point of why interest rates are dropping, is to increase borrowing, which helps stimulate the economy. What is going to happen with the real estate market in the near future? I have absolutely no idea. Hopefully it continues doing what it's doing at some level without too much craziness. But I think that a lot of sellers are starting to get on board, realizing that the market's come back and they're starting to list. So that might fizzle things out a little bit, right? Yeah. The multiple offer piece is simply because there is a shortage of inventory. And now, properties were down a little bit in 2019. They're back, and it might be a good time to sell if you're waiting for a certain dollar figure.
And again, as Dean mentioned with that example, if we do, just like they saw in China, maybe a little less extreme, see things kind of come up and it flattens out, it comes back. I mean, that was over the course of a month. There might be a little bit of a lull for 3 to 4 weeks on all sides, but things are going to come back hot and they're going to come back heavy, and it's not going to stop this year just based on the projection of where things are going. So if you have any questions, everything, keep in mind, this is your personal situation, right? So just reach out. The boys and I will look after you. So any last parting words, and we can end on a super positive note here?
Only thing I'd mention is if you're curious and you think you're on the fence and you might not buy because of this, just keep in mind, like, real estate is a long-term investment, right? Just like the variable, if you hold it long-term, it will come back. You will do well. You will create equity in that property, right? If you're buying a house thinking that you're going to make 50 or 100,000 in the next 6 months, I probably wouldn't do it. But if you're buying a property that you plan on holding, whether it be rental or owner occupied, I'd say there's never a bad time.
Yeah, and honestly, it's a fantastic time right now with everything we just discussed, the interest rates, the opportunities. It's just a fantastic time to get.
It is. Hey guys, thank you so much for tuning into the podcast. This has been a lot of fun, special episode here. We're going to keep things going. We got fantastic feedback so far, but we'd love to hear from you guys. Hey, give us a review on iTunes if you can. Shout us out on Instagram at Thrive Mortgage Co., Facebook, whatever you'd like. Hit up the boys here. Let us know what you think. We'd love to hear from you. So thank you so much for checking it out and tuning in, and stay tuned for the next episode.